Good Tuesday morning from Yahoo Finance's New York City headquarters studios. I'm Yahoo Finance Executive Editor Brian Sozzi. I mentioned it on Monday, but it warrants repeating today. You could feel the nervousness creeping into these markets. The selling pressure that started in crypto has spread to hot pockets of the market like the Mag 7 stocks and even gold. Experts have quickly gone from saying markets are experiencing a garden variety pullback to a warning of a full-blown correction, which would be around 10% or so. I want to get a snapshot of the technical damage we are seeing play out in the markets right now, and for that, there is no one better than Yahoo Finance's Jared Blickery. Jared.
Thank you, Brian. Let's take a look at how the major indices are doing real quickly. Then we'll get into the Mag 7 and even crypto. So Dow starting off the day down about 479 points or 1%. This is what's happened over the last 5 days, down about 4% there. NASDAQ off less than the Dow. That's an interesting situation, but also down 0.6%, almost 4% over these 5 days. And then the S&P 500, very similar situation. So let's break into the sector action because that has really been telling the story here. I was just talking with Julie Hyman 30 minutes ago about the 50-day moving average. Now you have the S&P 500, the tech sector, NVIDIA, the SOX, that's the Philly Chip Index, all trading below that key technical line. And here's the sector action. What's not working today the most? Consumer discretionary. We're going to check out the NASDAQ 100 in a second. Then second place, second to last, we got tech. That is down about 1%. Both of those are underperforming. Only thing in the green there are two defensive sectors. That would be utilities, staples. You can also see consumer staples trying to flash green there. So let's check in on the NASDAQ 100 and the Mag 7. We got NVIDIA down 2%. As I said, just crossing underneath that 50-day moving average, that key technical level. Spotted green here. Apple's up about 0.9%. But overall, not only the Mag 7, you could call it the Mag 10, maybe the Mag 15, experiencing some pressure here. Meta down 1.5%, Tesla down 1%, Microsoft down almost 2%. And related, and I say related because I think crypto has been leading the way down. It started its sell-off several weeks ago. Bitcoin down 2.5%, Ethereum down 2%, and Ripple also down by 1%. So not looking that great for Bitcoin. Let me just show you the 1-year chart real quickly, and I'll send it back to you. Over the last year, only holding on to gains of about 1%. And now we have thoroughly sliced through some critical support levels, and we're just trying to find that next equilibrium point right now, Brian.
All right, Jared, I like that. Mag 15, you're the man. I appreciate it. Similar to what Jared just ran through on the Yahoo Finance Interactive, I'm also in the weeds in the markets at this important juncture. Here's what I'm watching. Home Depot is trading off on a weak quarter, despite the stock being down 10% on the year prior to the report. Good example of bear creep in markets. More on HD's results later on in the show. On Monday, the S&P 500 index closed below its 50-day moving average for the first time in 139 sessions. That is an interesting stat. More of the NASDAQ composite components are trading at 52-week lows than highs, points out the team at 22V Research. And the magnificent 7 tech stocks are off nearly 5% in November, with only Alphabet in the green. So lots going on here. A lot of it is not very pretty on the eyes. Here on the opening bid roundtable, Lee Munson, Portfolio Wealth Advisors President and CIO, Noelle Acheson, author of Crypto is Macro Now and former head of research at CoinDesk, and Yahoo Finance reporter Brooke DePalma. Lee, coming out of the block with you here. The sell-off intensifying a little bit. Any concern on your part?
Oh, I'm waiting for the sell-off. You know, I was rebalancing back in June and July, so I've been waiting for a nice 10% sell-off. You know, NASDAQ, we're halfway there. Even though you adjust for beta, I probably want to see 12, 13%. But we're a third. After today, we may be halfway to a 10% correction on the S&P. What you have to think about is what are earnings going into the next year? We've got, 20% plus earnings on the NASDAQ, 15, 16 on the S&P. Even small and large cap value are low double digits. So I just need a pause. I need a little refresh. I need an excuse to sell my 30-year treasuries, my 2-year treasuries, and go buy stock. And I think in about another week, I'm going to be there. So I'm very excited, and I hope that people are not super hyped about NVIDIA tomorrow. I think that that's going to be the thing that brings it down. Just remember, the crypto thing, it's all part of that risk trade. It's starting to crumble now. You just got to let it happen and get your cash ready to buy.
Lee, in about a week, where are you going to buy? What sectors?
Oh, I would still look at the Qs. I'd still look at AI and tech. I still love that stuff. You look at, some of my favorite Mag 7s are the El Cheapos, like Google, that's my big love affair. Amazon, love that. Then I think I want to go and I really want to add to some of the larger value names because, if we disappoint next year, a little bit on growth, a little bit on AI. At a 33 multiple on the NASDAQ, you don't have a lot of cushion there. But when you're looking at some of the value names, they're still going to grow at 10, 12, 13% next year. You're looking at a 14, 15, 16 PE. If you have a little bit of growth concerns going in next year, I don't think you're going to compress those multiples. But I think you go barbell. You go all the way to AI. You go all the way looking over at small value. And I think that that's the way you got to play it.
Noelle, let me get you in here because of the sell-off that Lee is mentioning in many hot areas of the market, like AI, it arguably started in crypto. From your vantage point, what is driving this sell-off, and what are some indicators you're looking at that it might be over?
Hi, Byron. Great to be with you. The sell-off is totally driven by liquidity expectations. We have to remember that Bitcoin especially, but crypto in general, is a leading indicator of macro sentiment. It's one of the more liquid risk assets. It's the only one that trades on the weekend, and is also the only one that doesn't have cash flow or corporate partnerships or any AI froth to potentially boost its outlook. So it's a pure leading indicator, and it has been signaling this sell-off now for a while. The narratives that have been keeping it buoyed, they're kind of flimsy. They're the digital asset treasuries, which are flimsy leverage. Stable coins, again, not that interesting. I totally agree with Lee. The sell-off is welcome. It's needed. It's going to be very painful for many people, though, that didn't really want to face the reality of the new paradigm that we're in.
Noelle, let me follow up on that one. Is this sector out of catalysts? I was talking to someone in the crypto space yesterday. They mentioned the Clarity Act, but that's next year. And even that person I talked to wasn't necessarily like, wow, that's the next big mind-blowing catalyst to the upside. Like, what gets crypto back to those record highs?
That's an excellent question, something I've been asking myself. What always drives any leg up is new money coming into a market. And that for crypto has a different meaning in that there's a lot of the market that is not invested in crypto yet. You look at any investor survey you choose, and they will show you that the vast majority of macro portfolios have yet to take a position. So there's that floor to the Bitcoin price and also that potential driver for the upswing. You're totally right. The Clarity Act will be great news if it comes, but it's struggling, and there's still regulatory uncertainty of the impact of DeFi, for instance. And basically, right now, it's the macro story because the crypto stories are struggling with the same old narratives as always. It's a macro story. Another catalyst will be liquidity issues. When we see the Fed start to step in to ease liquidity concerns in the market, that will also send Bitcoin running first as the leading indicator that it is.
Lee, you and I have been doing this for a hot minute, and 20 years ago when I started out in this field, copper prices, when they would go down, everybody would be concerned about what that meant for the broader market, the Dow Jones transports. But let's zoom out to modern day. I mean, is crypto the new canary in the coal mine for the broader market?
I think it is. I mean, oh my gosh, I can't believe we've been doing this for so long.
We have. We still look great, Lee. We're killing it, man.
I feel I look amazing.
You do.
But at the end of the day, we don't care about copper that much. We're not really into the transports that much. I mean, we still care. But at the end of the day, when I look at technical charts, which I do every once in a while, I love the voodoo, I find that Bitcoin is basically leading markets from about 2 to 6 weeks. It's not quite there yet. We can't really put, it's not something you can put money on. But when I see crypto in a bear market, a couple weeks, 3 weeks ago, I figure I have about 2 to 6 weeks. So that's why I say provocative things like by next week, we're going to have a full scale correction on the S&P. It's strictly based on what our other guest is saying, right? Is that crypto is the risk emotional asset. So when it sells off, you'll also notice you got quantum, robots, whatever AI, whatever Bitcoin treasury, garbage is, and that is the canary in the coal mine. It also leads on the other way. So when you have crypto really rebound and really shoot up, basically that means is that the hot money's starting to work, and you know how that goes. It infects the rest of the market. So I think that you have to look at it. I'm not exactly upset about it. It just tells you where the hot money is. And I don't care really what it is. The hot money is always sort of generally wrong, but directionality, the hot money is always right.
Brooke, and it's not just the cryptos themselves that have come under pressure. I'm looking at Robinhood, at Coinbase. Of course, their results are very tethered to what happens to crypto. I'm really starting to get worried about these fourth quarters, and I think that's what the market is starting to price in with those names in particular, which have been on a strong run for the better part of a year.
Brian, they've been on a strong run, it feels like almost up until this point. And what we've heard from many of these companies is this ongoing demand, this hype, these expectations moving into the fourth quarter, but investors really waiting to see how exactly this all plays out. And with so much momentum getting baked into these stocks year to date, over this past month, we've definitely seen a bit of a pullback as consumers are a bit fearful about these risk-on assets, including these companies that have really led this cryptocurrency demand.
Noelle, let me get you back in here. In this environment, when these prices are coming back or pulling back so quickly, there's always people left holding the bag. And it's not just the retail investor. It's those whale people that got in around the top and were out there pushing even higher crypto prices. Is that the next shoe to drop here?
Could well be, Brian. We have to remember we're coming into year end, and there are going to be some very attractive losses to be harvested for tax purposes. That could be something that keeps crypto muted for a while. In the end, sentiment does its thing. When you're losing money, it's hard to cut that loss. We know that. But then again, eventually you just get tired and you rotate into something else. Interestingly, we're seeing a fascinating trend in this crypto correction that I've never seen before, and that is Bitcoin dominance. The weight that Bitcoin has in the market, and ETH dominance. They're both falling. Always, when you get corrections, they rise because investors rotate from the smaller crypto assets into the larger ones. Now we're seeing rotation out of crypto, period. Not into the larger assets, out of it, period. And where is it going? Probably not stocks, probably not bonds in this environment, probably into cash. That reinforces that crypto is now a macro market.
Noelle, in the early days of crypto, and I'm sure you can appreciate this, we would have these crypto winters, and there'd be fears of, Bitcoin's going to go to zero, it's not going to be around anymore. If we are going into another crypto winter, how would you define it?
It will be price-driven because crypto development is continuing. We're unlikely to get the same kind of crash that drove the last one. The fraud police are doing a much better job these days, and skepticism is relatively healthy. Well, I'm concerned about the digital asset treasuries. They took on a lot of leverage to accumulate positions. Most of them are underwater right now. We're going to see some unloading from there, but there isn't the same systemic level of risk that we saw the last time crypto winter set in, and the regulatory environment matters in this case. It is very, very different under this administration.
Lee, what's more exciting to you on this pullback? Let's say it is a week from now and we're down a little bit lower like you would suggest. Is it that AI stock or is it something like a Bitcoin?
Oh, please. I like AI stocks over Bitcoin any day, any time of year, because there's hope on it. We have a huge build out that we're going to do over the next couple years. And I understand we can chart crime it. Brian, we can just keep putting debt to equity ratios on Oracle and keep talking like it's a bubble, right? But this is not .com. I was there during .com. I made and lost many, many fortunes during .com. And this is sort of fundamentally different. Now, is there excess? Of course there is. Are there concerns about how we're going to support all this AI infrastructure? Sure. But Bitcoin is just a price and a chart. AI is something that in a couple years we're all going to be doing. We're all doing it now. It just depends on how quickly places like Microsoft and Facebook can get us to start paying them, how OpenAI is going to start paying them. I mean, even people are paying Claude. I'm spending thousands a year now in subscriptions for various AI tools. Okay, and I don't really feel like I'm an early adapter. I feel like an old guy. So I think when you start looking into next year, the earnings are there, the momentum is there, but you're going to have to deal with the pullbacks and you're going to have to deal with very sharp, high volatility because AI just has more beta. So what you think is a 10% pullback might express itself in AI stocks 15, 20, 25, and that's going to be completely normal. But go with what earns money, not something that just sucks up electricity and has no revenue model.
Damn
I
you,
think in 12
Satoshi.
months we're going to have it.
Damn you, Satoshi, for creating this stuff. But anyway, this is the roundtable I needed today in my life. Hang with me, y'all. We'll be coming back much more ahead on this show. Coming up, Home Depot's lame quarter this morning has me concerned about one retailer often in the same shopping center as Home Depot. More on that next. Welcome back to Opening Bid. I am locked in on some bullish comments on General Motors by the team over at Jefferies. The analysts there jacking up their price target on the stock to $75 from $55. It assumes about 10% upside from current price levels. They cite three reasons for the bullishness: less tariff headwinds, reduced CO2 regulations from the Trump administration, and a more focused GM when it comes to making loss-making electric vehicles, or EVs. On all these fronts, here's what GM CFO Paul Jacobson recently told me.
You know, I think this is just a testament to the resiliency of the GM team. When you look at what we've done over the last several years in terms of reducing our inventory levels, being lean, and being able to respond quickly to the changes around us, this is just another example. And as we started the year, tariffs were all the noise, and we said that we were going to be able to adjust and work through it. And now we're on a track to be able to lean on that track record and ultimately look to a 26 that could be better than 2025.
All right, let's hit my stock of the day. From General Motors to Target. Whenever a well-run company puts up a sucky quarter, it always catches my attention, because if a best-in-breed company misses their numbers, imagine how a struggling company in the same sector is doing. Today, that less than inspiring quarter is from Home Depot, which warned on the state of the consumer just a few days away from Black Friday. Home Depot is one of the best-run retailers in the game, and they have been for eons. On the opposite side of the spectrum in retail is Target, a company that has been disappointing investors and its customers for more than 2 years. When the company reports earnings on Wednesday morning, I would expect ugliness across the board. That's in part due to pressured consumers spending more cautiously because of prices. Their prices every day on everyday essentials are still high. The other part is Target is just not competitive with Walmart on prices, so it's hemorrhaging customers. You can see on the Yahoo Finance platform, Wall Street is also still cautious on the stock. Most analysts on the street are neutral or sell-rated on Target's stock, despite it being down 35% this year. They're just not seeing value in Target's stock. Let's get the opening bid roundtable to weigh in. Lee, let me come over to you here. Any interest in trying to pick a bottom in Target?
Zero, because they have declining sales. They have declining same-store comps, and they have to turn that around. It doesn't matter how cheap a stock is. Listen, man, I've been a value player since I was 5 years old. And one thing I've learned since, I'm 50 now, is that if you don't have accelerating earnings, valuations don't matter. And so Target has a few things not going for it. They've got their big political backlash on the DEI thing, so you don't have the good feelings of Target. They can't execute just in general, which is a whole other issue. And I think more importantly, they can't hide out in the bunker on grocery. Walmart just kills on grocery, right? And while they have some frozen foods and this or that, a family can't go to Target and get all their staples and all their needs there. And so, it's just a matter of you can't fight the macro. And when you have macro headwinds, and then you have decelerating earnings, the stock, at best, it's just going to go flatline for a while. So I say stay away. You could see some pop. You could have management tomorrow say some a few good words. But how lasting is that going to be? I think this is just a problem with the American consumer. And remember, the top 20% of American consumers are driving markets. So when you're dealing with the bottom 80%, you're already in East Berlin.
Lee, what PE ratios were you crunching at 5 years old, man?
PE ratios at 5 years old, man. I used to want to buy stuff. I was taught, you buy something at book value, or you buy a stock at $10 that has 13 in cash. Last time I saw that was middle of 2000 on Apple Computer.
Brooke, let me get over to you, because you have the Home Depot earnings story right now on the Yahoo Finance homepage. Not a good quarter for this company at all.
Brian, what Home Depot is really banking on is this improvement within the housing demand, within the housing market overall. And what we heard from executives on the call is that the expectations that they had for the second half of the year did not play out how they expected. The CEO saying that we did expect to start seeing some pickup in demand in the second half of the year, and this just wasn't the calendar dynamic of things, that they would be better in the second half. They said the overall economy in housing wasn't what they expected. They expected interest rates and mortgage rates to come down, which they did, but there's just this ongoing uncertainty around the consumer and this pressure in housing that they said are disproportionately impacting housing demand right now. And that led the company to cut their fiscal year outlook, including that adjusted earnings outlook. The ongoing uncertainty around the consumer and how much exactly they're willing to spend on housing improvement, ultimately taking on another house and ultimately taking the risk of moving out of their house when maybe they have a lower mortgage. And then also this plays into the holidays. What exactly it will look like, whether or not consumers will get out to Home Depot. They'll maybe invest in a new, holiday sales, holiday decor, or a new Christmas tree. And that's all sort of playing into today. This was not the quarter that Wall Street had expected, especially after we saw that turnaround in sales growth back in August.
I will say, though, Target always, and even Home Depot, giving great discounts on tree lights. I'm a big fan of both stores for that product. All right, Google CEO Sundar Pichai is dusting up a few new headlines. Here's what he told the BBC in a new interview on the current AI wave. There are elements of irrationality. My question of the day is this. Are there just elements of rationality, or are all the billions being spent on AI infrastructure and to fund AI startups irrational? Noelle, let me get you in here. I know you cover crypto and Bitcoin, but when you look at AI more broadly, are you concerned by what we're seeing?
Yes, I am very concerned. The valuations have been uncomfortable. I think everyone is starting to feel that level of discomfort. And while we can argue that this time is different, there actually are earnings in some of these, and many of us are paying for them on a personal level. There are earnings. It's the capex. Is that really going to be justified by the revenue that's coming downstream? And the changing nature of tech industry broadly. These asset light companies are no longer asset light. My concern, why I follow this, is because of, well, as Lee said, you can't fight the macro. Of course, what the macro economy has been driven by AI spending. If that turns because of increasing doubts about its ROI, then what does that do to the economy? What does that do to the consumers that we're starting to see reflected in some of these consumer company earnings? And then what does that do to the liquidity that is going to need to come into the market to keep it afloat? Because we just can't have big stock market drops, just not allowed.
Lee, what do you think about Sundar's comments here?
I love that guy. I'm long his stock. It's one of my larger positions. I think he's right. I think that when you want to look at where the excess is, you look at a chart of Oracle over the last 3 or 4 months. And I think that when you're thinking about, building supercomputers the size of Lower Manhattan, investors are going to give this about another 12 to 18 months before they start demanding to see the plan for return on invested capital. Let me warn everybody, though, about how the cable industry, even though it was slow like a turtle in the 80s and 90s, it never made much money. It just had more and more debt. And yet John Ballone's a billionaire. So I think that we have to remember, while this is a fascinating technology, that the build out is hard to get your mind around, there are going to be a lot of winners. And the trick is separating those out from the companies, especially in private credit and in the bond markets, that are going to get crushed. We built out a huge superhighway of fiber optics 25 years ago. There were some winners and there was a lot of losers. Your job as an investor is to figure out to be on the right side of the bifurcation of the AI that's going to happen in about another year or so. So just make sure whatever you own, it's either making money off of productivity increases in AI. That's where you have the case for, maybe large and small value, downstream there. And then you have to look at the big guys and say, does Google have the right strategy? I think they do. Does Meta have the right strategy? I don't own the stock, so I think that's what I have to say. And does Microsoft have the right strategy? Microsoft has another 4 quarters before we start to ask, how much are you charging people to bolt on Copilot, and is that working?
Big roundtable today. Y'all crushed it. Thank you, Lee Munson, Noelle Acheson, and Brooke DePalma for joining me today. Appreciate it. Straight ahead, Julie Hyman has you covered for Market Catalyst. We'll be right back.